It's the Real Estate Podcast, brought to you by ANZ Home Loans for financial well-beings.
A lot of people are coming in with incorrect expectations of what selling real estate really is with these real estate shows, and we think that it's all nice cars and nice watches and huge money. What those shows don't show is the amount of work that goes in, especially in those early years, in building a client base and getting the correct training, being with the right people around you and making sure you're getting that mentoring. It's so important that these offices have a really good minimum 90-day onboarding plan where they can start to show people the ropes. And then, as you mentioned, shadowing, and coming up and assisting an established agent, sitting back and watching how it's done, making sure your dialogue's right, making sure that your level of customer service is correct. These are all such important things, and it's something that's not happening a lot of the time, which is why there's such huge turnover within our industry.
Yeah, we'll get to the transparency of that training in lead generation in just a moment, but I do want to ask you about principals up and down the country and what they're looking for as far as new agents.
For a lot of franchises, they are still stuck in the past where they are thinking that they can just provide a brand, maybe some sort of technology platform, and they can just hand that to franchisees, collect their franchise fees every month, and everything's going to be okay. Times have changed. The old way of franchising is dead. It's gone. We've now got to be completely bespoke, and that every franchise owner is different, their marketplaces are different, and their ambitions are different. And we've got to gel around that. And it's really important that we go to our franchisees and say, what do you need? Where are you going? How do we help you get there? Not many franchise groups are doing that. In fact, very, very few. I know at Harcourts we are, which is why we're growing at the rate we're growing at.
This clear commission structure and support package, you do need, from a real estate company's perspective, from the franchisors, they need clarity for splits, desk fees. I want to talk about desk fees because I didn't know what that was. Also marketing costs, and when you actually get paid, that's all very important stuff for new agents, because many agents leave early because they just weren't warned about these lean months that they would have.
Any fresh agent coming into the market has got to earn some sort of steady income. So until you are experienced and fully licensed, you must be on some sort of either salary or debit credit system. So debit credit being where you get basically commissions in advance and that comes off at a later date. Commission splits are important, but not as important as the majority of the industry thinks. 100% of zero is still zero, if that makes sense. It's less about comm splits and more about being an environment that gives you the ability to succeed. And I think as an industry, we concentrate too much on that split, and that's not where money is made.
And you really do need this supportive culture, not a sink or swim mentality. The high turnover often happens in offices where agents compete internally and not collaboratively. So what you're looking for is a strong, inclusive culture that keeps people in the industry, Andrew.
Yeah, absolutely. I mean, culture is one of those words within our industry that's thrown around and not often really thought about. I've sat with principals and said, well, you need to understand if you want to grow, why is someone going to join you? And they'll often say to me, oh, we've got great culture. Often I think, well, you don't. However, culture is not what helps why people stay. It's hard to get it right because we're in such a competitive environment. Things like having group activities, making sure we've got clear rules around areas of focus of which they work in. What happens if two agents appraise the same property? Making sure that we focus on the client, because often we get so caught up in, well, that's my listing. Well, who did the client want to use? I think, we forget these things, and all of those things can breed bad culture. I've seen principals playing salespeople off against one another. Now, that might work in the short term to bring revenue in, but long term it breeds a very bad culture. And retention and recruitment is the hardest part of any business.
Now, this is pretty interesting stuff. 18 years after the GFC, the global economy may be edging towards a new kind of crisis, with AI driving extraordinary valuations at the moment. The history shows that when Wall Street catches a cold, Australia often sneezes with it. And in 2008, the shock rippled through our housing market, fair to say, for years. if today's AI boom becomes a bust, the first instinct is to assume that property prices are going to fall, but ironically, a sharp equity correction could push interest rates lower as policymakers move to stabilise the economy. Is that fair to say?
Morning, Craig. I would necessarily agree that while equity prices may fall and that may dampen sentiment, you're right in that depending on how bad things get in the real economy, you could actually see interest rates getting cut. And obviously an interest rate cut would be positive. I guess the one overarching comment I'd say on all of that is to see how bad things get in the real economy. And as it currently stands, while there's a lot of talk of an AI bubble, a lot of it really is an overvaluation. But there's no clear reason just yet around why we're going to see a big burst or a sharp correction in equity prices at this point in time. While there's an overvaluation, that can last for a lot longer than you expect. And so I wouldn't necessarily say there is going to be a big burst coming anytime soon either. And, frankly, you could have said that it looks like a bubble even 6 months ago. You could have said that 12 months ago as well. So we've been in this situation for a little while. We've seen historically as well, bubbles can last a lot longer than you expect. And there may well not really be too much of an impact on the real economy. It's definitely not like the financial crisis from 2008 in terms of the setup and where we're at.
Interesting about the overvaluation, because just last week I made the comment about a New Zealand super fund back in 2010. They made an investment of $300,000 in NVIDIA. That is now valued, their investment, their 300K, valued at $3.2 billion. So that's a bit of a point in case, isn't it?
That's exactly right. They've obviously done very well on that. And I think that's a very important point as well, is that although you might say we're in a bubble now and we might have a crash, it's important to remember that a lot of people have actually been on this way up for a long time. So although we might have a correction from where we sit today, the people that got in the last 2 years are maybe the ones that feel the most pain. But there's a lot of people that actually are still in a pretty good position because they've been on the trade for a lot longer than that. So it's not all doom and gloom for everyone is probably the important way to look at it.
Shame that we went on that, because if you had a lazy 50 grand, that would be worth $383 million. Boy, that'd be nice leading up to Christmas.
Exactly.
Now, Australia's housing market, it has this long history, doesn't it, of performing well in unlikely circumstances, even during the global disruption. So a correction in the AI sector might spook financial markets, but people at the end of the day, they still need somewhere to live, and demand continues to exceed supply.
That's exactly right. And if you look at it historically, our housing market has always been a lot more resilient than some of the other markets overseas. And that's also a function of the fact that our lending has been a lot more controlled, a lot more careful. And our regulators have also done a good job in terms of making sure the banks are actually doing a good job as well from that perspective. And so from that setup, you can see that we don't have the same issues that, say, the US market had in 2006, 2007 with subprime lending and everything else that was going on there. So our market is definitely set up a lot better. You've got a strong undercurrent of demand coming through, and you do have a constant supply shortage, which has been a problem as well. So I really don't think that we have the makings of a big crash or anything like that. Even if there is a burst in the AI bubble, it might be a bit of a sentiment dampener, but beyond that, nothing's actually changed in terms of the fundamentals.
Might be a really nice time to go and watch the movie The Big Short, especially if you're listening this morning and you're just not quite sure of what happened last time. I've seen that movie, I reckon, probably at least four times now, and every time I watch that, I learn something new.
No, I totally agree. I mean, that it was a very interesting movie and a very different setup, though. I think that's important to remember as well. And I think one of the biggest differences between our housing market and what the US had there was the fact that we don't have non-recourse debt. Well, ultimately, if you can't pay the mortgage and default on it, then you can't just hand over the keys and walk away from it. And that setup is incredibly important in terms of understanding the differentiation between the two markets. And like I said, our regulators have done a very good job in terms of making sure that the lending that's being done isn't out of control and isn't irresponsible, and it's been pretty well managed.
Grab your weekly dose of inspiration to help build a real estate portfolio. We talk to the best in the business every day. Learn from the professionals and know your property with us.
And a couple of historic things that happened on this day. All the way back to 1954, the first Burger King opens in Miami, Florida. Yeah, so many burger joints to choose from these days. Not all healthy options, it has to be said. Some to be avoided. It's always the independent burger operators, though, that I prefer over the big franchises. And on this day back in 1991, Pan Am, once the world's largest airline, officially ceases operations. Are you old enough that you took a flight on Pan Am and ingested some of that second-hand smoke? Now, Domain on this day has got their end-of-year wrap. Now, that is out. It's a look back across our real estate year. This report of yours is very succinct in its bullet points and commentary on all of the capital cities, the graphics, and the pacing. Very easy language, so pretty well done. And I think that when people read it, will find it not only full of information, but it's a fun read, Nicola. And whoever said that about a real estate market report?
It's so lovely to hear. And I have to say, it is my favourite report. And it's a really hard report to actually author as well, because you're capturing an awful lot that has happened in the 12-month period and really capturing kind of what's changed the dynamics across our different capital cities. But also it really showcases the rich data that we have at our fingertips at Domain, because we're looking at keywords that buyers are searching for, the highest in demand suburbs. So some really interesting angles throughout the report and across our different capitals.
Let's kick off firstly about those prices rising everywhere. By the end of this year, you're saying that 9% growth for houses nationally and 7% for units.
And look, that's really the paradox of 2025. When I was thinking about, what really shaped our housing market this year, but those rate cuts finally came to fruition in 2025. And what we saw is obviously improved borrowing power. When you look at the 3 rate cuts, so 75 basis point in rate reductions, that means your average dual income household had borrowing capacity increased by roughly about $74,000. But this is the paradox of affordability, because we saw borrowing capacities increase by $74,000. But what we're expecting by the end of the year is a 9% increase in house prices, which is a $99,000 increase in house price across the combined capitals. What we have seen is house prices have risen faster than what borrowing capacity is improved by.
Yeah, pretty incredible stuff, really, for 2025. You also have a segment where you're talking about the investors flooding back into the market, competing with, of course, first home buyers, which is very, very frustrating for these first home buyers out there trying to get onto the property ladder.
Absolutely. I mean, when you look at investor lending, we've seen it increase by more than 20% in the first 2 quarters of 2025. And it really did lift their share of overall housing finance to above 40%. And this is the highest activity that we've seen in almost 10 years from investors. Now, investors really do chase capital growth. And I think what we're seeing is previously they were really focused on the West Coast. So we were seeing strong rates of price growth in Perth and even to the extent of Adelaide as well. But I think what we've got now are investors are coming back into our big capital city, and that is Sydney. The chase that's now occurring and even somewhat back into Melbourne as well. And you rightly said, I think the one to watch ongoing really is what's happening in the investor space, but also in the first home buyer space. We've seen the expansion of the home guarantee scheme is now in play, and we know that that is going to bring first home buyers to market. It already is, and will continue to support in that first half of next year. And we've also had the government, they only released last week, the date of the Help to Buy. I think it's early December is when the Help to Buy, so that's that shared equity scheme with government is going to come into place. So I think this is going to be a segment to watch. I mean, we've pretty much seen, even when you look at the affordable sector of our housing market, so that 25th percentile, which is the lower end of our housing market, it's outperformed in terms of price growth.
Good morning, Craig. Thanks for having me. Well, unfortunately, we're not at 950. Last week, we were at 980,000 for a median house price in Penrith, and just a week later, we're now $10,000 more at 990,000. I'm sorry to say to your listeners.
Well, that is a very telling story of just how quickly the real estate market can change from week to week. You know, it used to be quarterly to quarterly changes or every second month, but now, as you have just highlighted, it's week to week, which of course is the breeding ground for FOMO. Let's not forget about that. And we're going to see a lot more of that next year. But you have just highlighted the very nature of price movement.
Certainly, and the time that I was checking these figures last week, when the median price in Penrith was $980,000, that was for a house. That was the same median price for a unit in the city, and the unit price in Penrith, the median price was $570,000, and that's gone up $5,000 in a week to $575,000.
And we should look at the mum and dad investors helping the kids out in your market in Penrith. How much movement in that area are you seeing at the moment?
Well, it's a good time to ask that question, Craig, because we've got that experience right now where we have a one-bedroom apartment that's listed for $590,000, but then the contract hasn't been signed yet and that buyer's not ready. Whereas we have another buyer that's got the bank of mum and dad where she's come in with an offer of $540,000. We do deal with a lot of first-home buyers that haven't got their loan pre-approval yet, so we're not able to entertain that offer at the moment. But if they end up having loan pre-approval that they've been told by their mortgage broker of $500,000, then the bank of mum and dad would need to come in with an extra $70,000 to help that buyer secure that property. Based on this price point out here in Penrith, the kids are living with mum and dad and they're saving. So they're not necessarily getting charged board, but what we'd be using for board is going into savings. And so the bank of mum and dad is twofold. Number one, it's making the child or I guess you call it the son or the daughter, have forced savings and they're actually ready to buy a property at a young age, in their low 20s. And then alternatively, there's the other bank of mum and dad, which is literally putting cash in as a gift to help the son or the daughter, get into the property market.
We are your local source for unbiased, expert insights into the world of real estate. We are not a real estate company. Our only objective is to help you better understand the real estate market. We connect you to the best real estate information across Australia. The Real Estate Podcast.